What if the thing you've been calling your greatest asset is actually your biggest financial liability? Not the obvious ones, not the mistakes everyone warns you about, the ones nobody talks about, the ones that show up on your balance sheet looking healthy while quietly draining your wealth from the inside out. I've watched entrepreneurs build impressive-looking portfolios, multiple income streams, real estate, investments, growing businesses, and still end up broke. Not because they weren't working hard enough, not because the market turned against them, because they were holding the wrong things and calling them assets. Today, we're going through 8 assets that look legitimate, feel legitimate, and are destroying your wealth in ways you probably haven't noticed yet. And I promise you, at least 2 of these are sitting in your portfolio right now. Welcome back. If you're new here, this channel exists to give entrepreneurs the financial clarity that most people only get after making very expensive mistakes. What you're about to hear isn't theory. These are the patterns that repeat across failing businesses and struggling entrepreneurs in every economic cycle, regardless of industry, regardless of income level. Subscribe if you want to stay ahead of those patterns. Now let's get into it. Asset number 1, a business that cannot run without you. On paper, it's your most valuable asset. It generates revenue, it has clients, it has a brand. Every business valuation model says it's worth something. But here's the question that reveals the truth. What happens to that business if you disappear for 6 months? If the answer is it collapses, you don't own an asset. You own a job. An expensive, high-stress, completely illiquid job that you cannot sell, cannot step away from, and cannot scale beyond the limits of your own time and energy. The technical term for this in business valuation is key man dependency, and it is one of the single largest value destroyers in entrepreneurial wealth. Buyers discount businesses with key man dependency by 30 to 70% at exit. Investors avoid them entirely. Banks price the risk into every loan. You have spent years building something that looks like wealth, and the market will tell you on exit day exactly what it's actually worth without you in it. The brutal truth: a business is only an asset when it generates cash flow independent of your presence. Everything else is self-employment with extra steps. Asset number 2, real estate that costs more than it earns. Real estate is the most emotionally loaded word in the entrepreneurial wealth conversation. Everyone wants to own it. Everyone believes in it. And a shocking number of entrepreneurs are holding properties that are actively destroying their net worth while telling themselves they're building it. Here is how the trap works. You buy a rental property. The mortgage, taxes, insurance, maintenance, vacancy allowance, and property management fees add up to, let's say, $4,000 a month. Your rent collected is $3,200. You are losing $800 every single month on an asset you believe is making you wealthy. But it's appreciating, you say. Maybe, but unrealized appreciation is not cash flow. You cannot pay your operating expenses with a number on a Zillow screen. Negative cash flow real estate is a liability with a great marketing department. It is consuming your working capital every month. Capital that could be compounding in income-producing assets while trapping your equity in an illiquid vehicle you cannot quickly exit. The brutal truth: real estate is only an asset when the numbers work today, not in the hypothetical future when you eventually sell. Asset number 3, illiquid private equity and minority stakes. This one destroys entrepreneurial wealth silently, and the victims almost always have impressive-looking portfolios when it happens. You took equity in a friend's startup. You made an angel investment in an early-stage company. You own a minority stake in a business that's been about to raise its Series B for 3 years. These positions show up on your personal balance sheet. You count them as assets. You factor them into your net worth calculations. You make financial decisions based on a number that has no market, no liquidity, and no guaranteed path to cash. Private equity positions in companies you do not control are not assets until the day someone writes you a check for them. Until that day, they are a hope. A well-documented, legally structured hope, but a hope. Entrepreneurs routinely overconcentrate their net worth in illiquid private positions and then face genuine liquidity crises when life requires actual cash. The asset looks real on paper. The cash simply does not exist. The brutal truth: net worth that cannot be converted to cash within 90 days is not financial security. It is a story you're telling yourself. Asset number 4: depreciating equipment and technology infrastructure. Every entrepreneur who has ever bought a fleet of vehicles, a server farm, a professional studio setup, or high-end machinery has made the same mistake. They put it on the asset side of the balance sheet and forgot that depreciation is not optional. Depreciation happens. Technology depreciates faster than almost anything. The $80,000 studio you built 2 years ago is $25,000 today. The software infrastructure you capitalized at $200,000 is functionally obsolete. The delivery vehicles on your books at $150,000 have a real market value of $90,000. The problem is not just the depreciation itself. Accountants account for that. The problem is that entrepreneurs make decisions based on the book value of these assets rather than their real liquidation value. They use inflated asset values to justify borrowing. They use them to feel wealthier than they are. And when a cash crisis hits and they need to liquidate, the gap between what they thought they had and what the market offers them is devastating. The brutal truth: book value is an accounting fiction. Liquidation value is financial reality. Know the difference before a crisis forces you to.
Before you close the tab, hear me out. Retirement accounts are genuinely valuable financial tools. This is not an argument against saving for retirement. This is an argument against entrepreneurs who are cash-starved, opportunity-limited, and desperately need working capital, but have locked hundreds of thousands of dollars into retirement vehicles they cannot access without a 10% penalty plus full income tax. The fundamental problem is this: retirement accounts are designed for employees who need to be protected from spending their savings. Entrepreneurs are not employees. Entrepreneurs need capital flexibility, the ability to move money into opportunities when they arise, to fund operations during downturns, and to invest in their highest return vehicle, which during the growth phase of a business is almost always the business itself. Locking $400,000 into an IRA while your business is starving for working capital is not prudent financial planning. It is the illusion of wealth, a number you can see but cannot use, while the actual engine of your wealth creation is running on empty. The brutal truth: for growth phase entrepreneurs, liquidity and flexibility are worth more than tax-advantaged imprisonment of capital. Intellectual property nobody is buying. Patents, trademarks, proprietary methodologies, unpublished content libraries, course frameworks sitting on hard drives. These are listed as assets on balance sheets and in investor decks every single day, and most of them are worth precisely nothing. Intellectual property is only an asset when someone is willing to pay for access to it. A patent that has never been licensed is not an asset. It is an annual maintenance fee. A trademark on a brand nobody has heard of is not an asset. It's a registration cost. A proprietary system that lives inside your head and has never been productized has no market value whatsoever. Entrepreneurs fall in love with the idea of their intellectual property long before the market has confirmed that love. They carry it at inflated values. They make decisions based on its theoretical worth. And they discover, usually during a funding round or an acquisition conversation, that the market has a very different opinion. The brutal truth: intellectual property has no value until the market assigns it value. Until then, it's an idea with legal paperwork. The vacation home called an investment. The vacation home is the entrepreneurial wealth trap hiding behind the most beautiful scenery. You bought a place in the mountains or on the coast. You rented a part of the year. You tell people and yourself that it's an investment. It generates some rental income. You feel financially responsible about owning it. But here is what the full financial picture almost always reveals. When you ACA-fund the mortgage, property taxes, insurance, HOA fees, maintenance, furnishing replacement, property management, booking commissions, and your own usage displacing rental income, the property is not generating wealth. It is consuming it. The vacation home delivers exactly one thing with certainty: lifestyle enjoyment.
which is a perfectly valid reason to own one, but calling lifestyle enjoyment a wealth-building asset is financial self-deception, and financial self-deception at scale over time is what quietly destroys entrepreneurial net worth more than almost anything else. The brutal truth: own the vacation home if it brings you joy. Just stop counting it as a wealth-building asset. It almost certainly isn't one. A large following with no revenue architecture behind it. This is the defining wealth trap of the digital entrepreneurship era, and it is destroying the finances of an entire generation of content creators and personal brand builders. Followers are not revenue. Views are not income. Engagement metrics are not cash flow. 1 million Instagram followers generating zero consistent revenue is not an asset. It is a full-time job with an unpredictable tip jar. The real problem runs deeper than that. Building and maintaining a large audience requires enormous ongoing investment, time, team, content production, tools, paid promotion. Most large following entrepreneurs are spending far more maintaining their audience than that audience is returning in revenue. And here is the structural vulnerability that makes it genuinely dangerous. You don't own your audience. The platform does. Algorithm changes, account restrictions, platform shifts in user behavior. Any of these can eliminate years of audience-building investment overnight. It has happened to thousands of creators who believed their following was their most valuable asset. An audience only becomes an asset when it connects to a repeatable, scalable revenue system, a product, a service, a membership, or community that you own and control independent of any platform. The asset is what you sell through it, not the audience itself. Your following is a distribution channel, not a bank account. Here's the pattern across all 8 of them. They all look like assets. They all feel like assets. But an asset has one job: to put money in your pocket. If it isn't doing that job, regardless of what it's called, it is a liability. The entrepreneurs who build real, durable, generational wealth are not the ones who accumulate the most assets. They are the ones who are brutally honest about what their assets are actually doing for them and ruthless about eliminating the ones that aren't. That audit, that honest, uncomfortable look at what you're actually holding, is worth more than any investment tip, any business strategy, any productivity framework you will ever find. Do it today before the market does it for you. If this gave you clarity, share it with one entrepreneur who needs to do that audit. Drop in the comments, which of these 8 do you think is the most overlooked? I read every single comment. Like, subscribe, and I'll see you in the next one.